Good day, everyone. I'm Ruben Torrens, and back from my journey to Spain to explore into my own retirement abroad. This is what we're going to talk about today: retiring abroad. The picture on the left side of the screen is the city of Malaga, Spain, where I spent the last 2 weeks. It was great. I have um, a lot of news to share with you, but it's not going to happen today. What I'm going to tell you today is what happened at home if we retire abroad in reality. What happened with our pensions, what happened with our taxes. And I'd like to start showing you our pensions and our Canada pension plan. The Canada pension plan is paid anywhere in the world. It's your own money, you put the money in there, you get it no matter where you live, it will be paid to you in Canadian dollars. But then we have all day security money, which is tax money. This is not money that you put, well, actually, you put the money in there, but in a different way, not making contributions, but paying taxes. And but all the security has a restriction. In order to be paid outside Canada, you need to have at least 20 years of Canadian residency. However, there is Canada has a social security agreements with several countries around the world, more than 50 countries. And if you live in one of these countries that has a social security agreement with Canada, so you may qualify to receive your old age security outside Canada if between the two countries you completed the 20 years. However, here's the trick: the social security agreement extends the time. Let's say you have 10 years in Canada and 10 years somewhere else in another country that has this agreement with Canada. Okay, so together you have 20 years. So how do your old age security will be paid? Anywhere outside of Canada, anywhere in the world that you live, but based on 10 years of Canadian residency, because that's your actual residency. So extends the time, but not the money. So up until here, we have seen what happened with our government pensions and the possibilities of receiving old age security outside Canada with less than 20 years of Canadian residency. But the problem is that all this money gets taxed. We pay tax. This is taxable income. And when we are in Canada, it's optional to have tax deductions when we get paid. So this is your call. So a lot of people is not going to pay any income tax at the end of the year because the income is not high enough, so they don't have any withholding tax. But if you live abroad, the withholding tax is mandatory, and this is what I like to share with you. It is complex, but the government, for once, they did a good job, and they have an excellent calculator online, and this is what I'm going to share with you now. This is a great tax calculator for non-residents and very easy to use. You choose the country of that you want to move to. Let's say you want to move to Brazil, and you choose different types of incomes that you might receive because every source of income is taxed differently. Let's choose a Canada pension plan, your monthly payments of Canada pension plan, and your all day security. Everybody has this too. Where is all day security? Right here. And then we will choose periodic payments from your RIF and a special withdrawal from your RIF, a lump sum payment also. Let's say, just to see the tax rate, we will do $1,000 each. And now we will calculate this, and it will show that the withholding tax will be $1,000 because it's 25% across the board. 25% for 1,000 on Canada pension plan or Quebec pension plan. All day security the same and the same. But this is depending the country of residency, because if we edit this and we switch the country to, for example, Spain, that I'm just coming from, okay, and we check this, we will find that the withholding tax is lower. Why? Because the Canada pension plan pays only 15%, and the holiday security also 15%, and the RRSP monthly payments, monthly withdrawals, 15%. But look what happens here. The RRSP lump sum payment, we have a withholding tax of 25%. And this calculator helps you not only to find what the tax rate is to your source of income in the country that you want to live, but also to plan properly, to plan around. Okay. Now, this is sort of optional because you can apply if you think that this is the tax that you're paying is too much because you're paying tax from $1, and if you think that is too much, you can apply to the government to lower the amount of withholding tax. And to do that, you need to use this form here. This is form NR5. So if you Google NR5, you will get to this form on the first Google result. And what you're doing is you're applying to the government, to the CRA, to have a lower withholding tax, a reduction on the amount that you're getting withholding tax. So at the end of the year, then you will file an income tax, a regular income tax, and you will be able to claim every single credit as if you happen to live in Canada. So this is if your income is on the lower end. I will say that you're paying too much tax under this concept if your income is, give or take, depending on the province in which you live, 45 to 50,000, around there. It should be probably the break-even point. But if you earn more than that, then this is your final tax liability. You save money in taxes if that's your situation. So if you complete this form and this is not in your advantage, the government is going to decline it. They will allow this form only if it's in your advantage. So make sure that you do this, that you explore this stuff and you complete this form if you decide to live abroad, because you're going to save money in taxes. I hope you find the video interesting. If you have any questions or comments, you can leave them below the video in the comments section. The link for the government calculator, you will find it on the description of the video, below the video as well. And other than that, thank you for watching. Don't forget to subscribe to the channel. Good stuff is coming. And I will see you soon.